Welcome. My name is David Bickerstaff. I'm an actuary in the Dallas-Fort Worth area. And what I've got in this video is a demo of a model we put together, calling it a retro rating calculator, which I'm going to walk you through and show you how this thing works. Retrospective rating is a concept that's been around at least as long as I've been in this profession, which is, let's say, several decades, and way before that even. I'm assuming that if you've clicked onto this thing, you have a general idea of what retrospective rating is. Again, it's been around a while, and it first came into being in workers' compensation in that field, and it's still extensively used in workers' comp, but in certain situations it's also used in for liability lines. So what I've done in this model is dealing strictly with a risk, an insured that has some liability policies that it would like to seek out a retrospectively rated policy, and this model does just that. When that concept first came into being, again, extensively for workers' compensation, the whole procedure was frankly a little cumbersome. You had several tables looking up numbers to apply to the plan, given a bunch of variables that describe the risk and describe the attributes of the workers' comp line, and frankly, it didn't allow the risk to have that many options. When you consider all of the variables involved here, you can understand what we're talking about. For example, some of the variables that come into play are the size of the risk itself, how much premium this entity will generate, what layer of liability the entity wishes to retro rate. In other words, do they want to use the first 100,000 of any claim, or first 200 or so forth? Then what selection they make regarding the minimum premium they are willing to pay or the maximum premium they want to pay for the retrospectively rated premium, the expense ratio underlying the premium level itself, and then finally the parameters that describe the line of business itself, the expected frequency and expected severity of the line, and the distributions around those expected levels. So when you consider all of those variables, the idea of putting together tables to allow the insured to select the combinations of these things, I mean, someone estimated, I think, once that it would take maybe 100 or 200,000 pages to do this. Well, so what we've done here is to incorporate all of these variables into one model, one calculator, if you will, that can be used for this liability line of business. One thing that is common to all retro plans, and the key driver of these plans, is in fact the probability distribution of aggregate losses expected for a particular risk, and whether that's workers' comp or liability or whatever, that's what really drives the whole game. So let's take a look then at this particular model and see how we address those variables and how the model works. In the first part here, we're going to define the risk itself. How big is it? And the line of business, what the expected frequency and severity is for this particular line. So we're going to start out saying, okay, and all of these numbers I filled in here are the default numbers, and of course they can be overridden to define any imaginable risk that one could come up with. So in this case, let's say we've got a risk that develops $1 million of premium. This could be a small hospital. This could be a clinic of doctors that pool all of their liability risks. It could be any commercial entity for their premises liability, or you name it, any kind of a liability that they feel that the entity thinks it has a critical mass large enough to have some skin in the game, to retain some of the risk. And the idea being that there's an incentive that at the end of a prescribed period, if the expected losses are less than what is built into the rate, then they say, okay, let's give me some of that premium back for the fact that I had better than average, better than expected experience. In other words, retrospectively rating the policy. Now, so we say this entity, whatever it is, develops $1 million of premium at a prescribed limit. Let's say the policy limit is $1 million, and that's the premium developed at that limit. Conceivably, they could have also excess policies above that $1 million limit, but that would be a completely separate policy, and we want to deal strictly with that first $1 million layer. Then the rate level we're dealing with, let's say, has an expense provision, total expense provision of 35%. This provision would include your general administrative expenses, your commission, brokerage. It would include your unallocated loss adjustment expense, ULAE, a provision for profit and contingencies, and premium tax. Now, some retro plans treat premium tax outside of all of this as a final multiplier. I'm assuming in this particular model that premium taxes are appropriately considered in the expense loading. So if we got a 35% expense factor, that would mean that the expected loss ratio is 65%. So that 65% loss ratio with $1 million of premium would imply, of course, that the expected losses are in the rate are $650,000. Now, it may well be, as in some liability rate structures, that underlying $650,000 is actually the present value discounted to take into account that losses will be paid out over several years, and that if you discounted those to present value using some interest rate, let's assume that would produce a present value factor of 0.925. So that's 650 representing discounted losses. Then if you determine what the undiscounted level would be of expected losses, you divide by that 0.925 and you get about, $703,000 as the total expected losses on an undiscounted basis. Now, here are some other items that have to do with the average cost per claim in this particular line. First off, and this may or may not be in the rate level that we're dealing with for this particular line, that we need to know, or at least have a good estimate of what the average indemnity is at this underlying $1 million limit. In this case, I'm using $180,000. I might point out here, all of these values I'm going to put in here are what we have found to be in the actuarial or in the rate filing that produced this rate level in the first place, and that had been thoroughly reviewed and approved and so forth. So we're not second guessing any of these factors. They are what they are at this point. So 180,000 estimated average indemnity at this limit of $1 million. Now, these next two items have to do with what percentage of claims are paid with indemnity or with ALAE only. So here again, these are probably in the original rate study or the original rate filing. We're saying 25% of claims will be closed with indemnity, CWI, and another 70% with expense only. And that would leave 5% with closed with no payment. And we have an average expected of loss adjustment expense of $30,000 on CWI claims, $20,000 on CWE claims, and so forth. All of these are, I use the word expected, but that's a special term here. The word expected in this context deals with a mean value of a distribution of values that can vary significantly on either side of that mean. Now, here are two items that are going to come into play when we estimate the final distribution of expected total losses for this entity. The rate filing underlying this rate level would have, or the underwriting manual for that matter, would have increased limit factor tables, and you know what those are. I won't try to explain. And let's say that for the 250 limit, it's 1.6, and for the million, it's 2.0. Now, I've chosen these two limits not because we need to use the 250,000 limit as the limit that's going to be used for the retro rating plan, but these are just 2 points in the distribution, and with those 2 points and with this average over here, we are going to eventually come up with a distribution of indemnity by size. Now, the insured now has a choice. How much risk do I want to take? I can have a plan where I limit my losses to 100,000 and have a rate retrospectively rated a rate that's retrospectively determined for only the first 100,000 of claims, or for the first 200,000, and so forth. The higher you go, the more risk there is, and for this particular example, I'm going to be modest and just choose 100,000 for my risk for my limit to apply. Now, given all of these things, we're now going to determine what the shape is for the distribution of aggregate losses for this particular risk, limited to 100,000 per claim. Well, first we're going to do it with no limit, and then we're going to find out, can we come up with a distribution such that when you limit it to $1 million, we have 180,000, and it also has an implied ILF of 1.6 for the 250 and implied ILF for $1 million for the 2, and so forth. So we're going to do this in this particular area with calculating these values. And so here's what we come up with. Given the average total cost per claim up here and the total losses, we now can back into the total number of claims expected per year. It's about 10.5. Now remember, only 25% of these claims are expected to be closed with indemnity, so that leaves us for 1 year total number of indemnity claims of 2.5 to 3 claims per year. And now this thing solves. It's sort of like if you're in Excel and you use the solver option, the solver button. You've got some values and you want to be able to determine what an unknown is. Those of you who have used Excel, you know what I'm talking about. So given all this information, we have then come up with an average indemnity with no limit of $192,000 and change, which, given a standard deviation of that distribution of about $300,000, the coefficient of variation here, CV, is the standard deviation of that distribution divided by this mean of $192,000, and it's about 1.5. The distribution whose mean is 192.5, limited to 1 million, is 180,000. So we kind of extrapolated up to get to that 192. It also will now produce an average at the retro limit, and we chose 100,000. So at that 100,000 limit, given this distribution, the average indemnity will be 76,000. So with that information now, we can determine, with the average expense up here and the total frequency expected, we can determine what the expected annual undiscounted losses will be at this 100,000 limit, and that comes out to be about 428,000. That's undiscounted. But again, using this same discount factor up here of 925, the corresponding discounted losses will be about 396,000. Now, all of these values we're talking about so far are on an annual basis. 10.5 claims, total losses 428, discounted 396. So it's this discounted total losses that we are going to determine what the implied annual premium would be at this $100,000 limit. The difference between the undiscounted and the discounted is a number 32,000. We're going to put a bookmark on that number because it's going to come into play later in the final retrospective premium calculation. So this is a key number here. 609,854 would be the premium required at the 100,000 limit. We got this by dividing the 396 by 0.65. You remember, that's the expected loss ratio. So dividing the 386 by 0.65, we get the 609 total premium, including the 35% expense loading, for the 100,000 limit, which becomes what we call the standard premium. In other words, that's the premium subject to retrospective rating. The total $1 million premium is not subject to it. What's left is 390,000, and that portion of the premium then applies to the 900,000 X of the 100,000, and that's a constant. There is no adjustment to that 390. It's there for that excess of 900,000, period. Okay, now we're at the point where we need to simulate the results of this insured, and the results meaning the losses from ground up up to the 100,000 limit. And we're gonna do that by simulating 10,000 random trials using all of these expected values representing the mean of distributions. And we're gonna sample from all of these distributions. And what's that? That's gonna be about 10 claims per year, 10,000 times, but we're gonna do this for the entire 3-year period. So that's what, the 300,000 claims that we're going to sample, and that didn't take very long. So that's the entire, now we set up 10,000 results here. We saved them, each result including the total losses for this risk subject to the 100,000 limit. Okay, now we're getting to the meat of the plan itself. The risk can now choose what window of premium he wants to pay. He can choose a maximum premium that he would be obligated to pay, and also a minimum premium. And by doing that, you select a ratio to this standard premium of 609,000, but the standard premium now is, you have to take it to 3 years, so it becomes about $1.8 million. So all of these are annual figures, and you have to take it to 3 years. So let's see what his options are. Let's say chooses to select a maximum of 110% of the standard premium. In other words, not taking on a lot of risk. Minimum premium, let's say he only wants to be obligated to take, to pay 60% as a minimum. Now, in the formula itself, losses are adjusted by what we call a loss conversion factor, and for this time being, I'm going to use a 1.0. At this point, let's go down here and review the actual formula to determine what this retrospective premium is going to be after the selected time period, and in this case, it's 3 years. Final premium is equal to the expense loading in dollars for the 3 years. That's a given. There's no variability. It's whatever that number is, plus a number called insurance charge. I'm going to define that in just a minute. The losses actually incurred, again, subject to the 100,000 limit, minus a discount, which is this number here. In other words, how much investment income the original premium drew over that period of time, and that number subject to a minimum and a maximum. Okay, so let's put it in these terms. If the losses incurred by this risk exceeded the level which would have produced this maximum premium, we're going to call that situation when the house loses. On the other hand, if the losses incurred by the entity produce a premium level which is less than this minimum, then in that case, the house wins. Now the question is, when you add up all the wins and losses times their respective probabilities, given the distribution of which we calculated down here, does it come out to be zero? In other words, would that be a zero-sum game where the losses and the wins offset each other? Anything between the 60 and the 110, we call that a push. The house doesn't win or lose, and that, you pay for your losses. Well, in this particular set of selections made here? The answer to that question is no. The House loses. I say the House loses. Of course, the House has a premium, the profit provision built into the rate up here. They don't really lose, but in any event, it's not an offset. There is no zero-sum game. So how do you do that? How do you make those two things offset each other? Well, you do it by including what's called the insurance charge. In this case, given those parameters, I'm going to click this, it's necessary to add 8.7% to the retrospectively determined premium, such that when you add up all the wins and losses, they come out to be zero. So let's see how this works. Now we've calculated the 3-year minimum premium, and that's 60% of 3 years of standard premium down here, which is $1.8 million, so that gives you about $1.1 million, and that's the minimum premium. The maximum premium is 110% of that $1.8 million, which is 3 times the 609, and that produces a little over $2 million. So somewhere between these two, the minimum and the maximum, basically you're paying for your losses plus this insurance charge to make it come out even. And there's the insurance charge right there. That's 8.7% of the $1.8 million, which is 3 times this number here. So by doing so let's review the formula again. Your final premium is equal to the expenses, that's the $640,000, plus the insurance charge, $159,000, plus the losses, and we're gonna put a sample in there in just a minute, minus the discount. So the question is, at what level of loss would produce, using that formula, the minimum premium? The answer, working into the formula, would be about $394,000. So if you plug $394 of loss into this formula, you would come up with the minimum premium. On the other side, $1.3 million approximately of losses working through the formula would produce the maximum premium. So if your losses are anywhere in between these two numbers, basically you're paying for your own losses, plus the insurance charge. So let's put in an example here. Let's say that this particular sample, we had $900,000 of losses during this 3-year period, in which case the final premium, working through this formula, would be $1.6 million, which is in between the minimum and the maximum, so that is the final retro premium. Now, to really bring home how this insurance charge and the discount amount work, I'm going to flip over here to the second screen. So we're going to do some reconciliation here. Okay, so we've got, for 3 years, expected losses undiscounted. Let's go back up. That's $1.2 million. What that is this number here, the 428 times 3, $1.2 million. We're going to discount that using that same factor, bringing it down to $1.189. And so the dollar of discount is the difference, the $96,000, which is this 32,000 times 3 that we calculated earlier. Now, when we paid the original premium, which of course was $1 million, and that comes out to be $3 million over 3 years, The subject premium, though, is that which applies to the first $1 million of indemnity. And over 3 years, that subject premium, which we'll also call provisional, is $1.8 million. The expense loading into that $1.8 million is 35% of it, which is $640,000. Now, for this particular sample, we're saying that the risk incurred $900,000 of losses. So let's see how that works. We chose a loss conversion factor of 1.0, so the actual losses times LCF is $900,000. We're going to subtract out the amount of investment income, basically is what that $96,000 is. That was the discount. And then we're going to add the expenses. You're going to pay that no matter what, the $640,000. And we're going to add this insurance charge, and that gives us the final retro premium of $1.6 million, which is what we got over here, $1.603 right there. Then, so if you apply the minimum and maximum, since this is in between the two, it's the same. So what's the adjustment that the risk gets at the end of the 3 years? Well, the retro premium is $1.6 million. The provisional premium was up here $1.8 million. So the risk gets a return of $226,000 at the end of the 3-year period. One more check on all of this. See how the cash works. The original deposit, taking out the expenses, original deposit, remember, is the 1.8. You take out the expense, and you've got $1,189,000. You earn the $96,000 of interest over the period. Then you get an adjustment of $226,000, and that gives you an available amount of $1,059,494. The actual losses were $900,000. So what's the difference? $159,474, which happens to be what you pay the vigorish to the house, so to speak, of $159,474. So it all comes out in the long run as a wash, but only after including this insurance charge. Now we'll go back here and let's try something else here. Let's say that this entity, instead of producing $1 million of premium, let's say only $600,000. Oops. A little smaller. Everything else is going to be the same. We're going to recalculate. Now we have only 6 claims per year. We're going to resimulate all of the 10,000 trials. We're going to keep the same parameters, 110% max, a 60% minimum, 1.0 loss conversion factor. Now let's see what the insurance charge is. Oops. See, the price of poker just went up. It's now 12%. And why is that? That's because it's a smaller entity. The volatility, the variability has been increased. And so you got to pay a little bit more to make this thing come out even. If I wanted to modify that by saying, okay, let's take a little more risk on the high side and calculate the factor, then it comes back down to a 6%. So anyway, you could play with this. There's just an unlimited number of options available here. The size of the entity, the nature of the line of business you're dealing with, how much risk you want to take on a per claim basis, and how much risk you want to take on a maximum and a minimum. And given all of that, calculate what that vigorish is, I call it, the insurance charge factor. And there you go. You get all the parameters, you plug in the actual losses for the entity, turn the crank there, and you got your final number. So Anyway, that's, we could play with this thing, you know, any number of combinations, but I think you see what this thing does. So, here is my contact information. I would love to hear from anyone who has any questions, comments, suggestions, criticism, whatever, about this calculator, if you will. And please feel free to email me or give me a buzz, and we can continue the discussion. Thanks very much for your attention, and let me hear from you.